Thank you for joining us. I'm Gord Long. As always, it's my pleasure to have back with me today Charles Hugh Smith, well-followed, prolific writer on the web who is the publisher of the website of2minds.com. Welcome back, Charles. I hope you've continued to be safe in Hawaii.
Yeah, thank you very much, Gordon. It's a pleasure. We haven't spoken since the beginning of summer.
How quickly it went. Do I dare ask how tourism in Hawaii, is it returning yet?
No, the state is attempting to open by tourism again by requiring tests. You know, to get on a plane to Hawaii, you're supposed to have a negative test. But that's procedurally, that's a complicated task, and so it has yet to fly, so to speak.
Good one. I like that one. Charles, before we begin, as I normally do, I need to stress with our new viewers that this is not an interview. We do these videos as a way of us productively dialoguing the important trends we are identifying and simply make these discussions available to the public for those that might be interested or want to contribute comments, which we both really welcome. Today we're going to talk about what might go wrong based on a number of assumptions and beliefs that you and I have generally see being held by the market participants. As such, we hope to cover the subjects areas we have listed here. As is typical, we have a significant number of slides, so we'll go through them quickly, but leave you to look at them or study them in more detail, because the number of the slides, we'll only pick a couple points, and there's a lot of points on the slides just for time. We currently have, I'll call them conventional financial assumptions, that everything's fine, rates will go negative, Fed and Treasury and fiscal spending will resume growth, COVID-19 was overdone, United States, the US dollar will go down. As a way of thinking, they're based on that there will be no deflationary crash, there'll be no crisis, there'll be no policy failures, nothing is wrong with the system. And I mean, that sounds a little exaggerated, but that's kind of what you draw the conclusion from. And we're going to go through each of the assumptions that I just listed there. But Charles, this is a slide I thought before we went through them that I put together. Actually, it says in the bottom there, 2012. But I put it together even earlier to that. That was kind of a final cut after the financial crisis. And they started talking about concepts like quantitative easing. And it just was bizarro to me at the time. And we were down here at the bottom there, misinformation, moral hazard, deceptions. And I said, if we do this, this is potentially what might happen. So we could expect misinformation, manipulation, malpractice, malfeasance, mispricing of risk, and malinvestments to actually foster the moral hazard I mentioned, but also unintended consequences, which would lead to distortions and potentially both dysfunctional and delusional markets. And Charles, I feel like that's what we're describing is going on right now today, 8 years later. Do you feel the same way?
Absolutely. It's remarkable how prescient your arrow, your trajectory here is. And we're going to talk about the delusions, that arise from the endless distortions, that have been put in to keep the thing afloat.
We've got so many distortions going that we've become delusional about how the system can sustain itself. And it won't, but I need to be really forceful here. What I have learned is don't ever underestimate how the government will change the rules. So even though logically this is going to end badly or collapse, what'll happen is they'll change the rules, and what you thought was impossible, that'll be the new normal. And does that mean, therefore, it's not going to collapse? No, it means that you've deferred it. You kicked the can down the road, or you're creating a new artificial world. And frankly, that's what we're in. So the world of capitalism is no longer working. And that in itself is a whole discussion. We've done many videos over at MAD-SII. But this next chart is it's a more recent roadmap we put out at MAD-SII. And we actually did videos on each of these blocks, how we see things unfolding over the next 18 months or thereabouts, going from left to right, and its underlying causes for it. And I'll refer our listeners to the macroanalytics YouTube channel for videos on all of this subjects. But the point is that these, where we see these things going, and it's all based on, and you'll see in those videos, solid analytic work. And so we could say, okay, we're flawed here, we're flawed there, but the assumptions that we showed earlier don't even come close to this as being a possible reality. So there's just major disconnects that it can only be described, as we said, being delusional. So let's start with the first one, and that is the whole look at the United States dollar weakness. And as it says here, that the U.S. dollar will weaken as Fed eases and prints, that the thinking is Japan and the Euro bloc are farther along in their socialization of debt, so the U.S. will have to play catch up, which will weaken the U.S. dollar. That's the thinking. So here are the points that might start to ask some questions. Can I ask you to take us through those points? Because I know they're yours, Charles.
Yeah, thank you, Gordon. Just to sort of preface my comments, I want to let everybody know that what I feel we're talking about today is of a piece of everything we've been talking about for the last 8 years. In other words, that roadmap that Gordon described is accurate, and what we're doing is we're filling in the blanks in the present, right? I mean, and so the COVID-19 pandemic, whatever you think about it, is a catalyst. It's not the cause of all these disruptions that are occurring. Those were the result of weaknesses that have been piling up like deadwood in a forest in the global financial system. So the COVID-19 is only a trigger, a catalyst. It's not the cause. Okay, so I want to be clear about that. And then the other point I want to make is that all these points I'm making fit into Gordon's thesis about inflation and deflation and stagflation. And he's has a number of presentations that you can watch to understand that thesis. But all of this feeds into that eventual stagflation and move from growth to value and so on. So with that kind of background, everybody's kind of counting on the dollar weakening for a number of reasons. They think that will drive equities higher, that will improve U.S. exports. But what people forget is the U.S. dollar is the most important reserve currency. If you look at the number of currencies that are held around the world as reserves, the Chinese yuan is like less than 1%. Japan is like less than 10%. Europe is around 20 to 30%. So the dollar is the dominant reserve currency. And so the Federal Reserve never talks about what it's doing to protect the dollar as a reserve currency. It only speaks about the domestic impact of the dollar. And so most analysts don't understand that Triffin's paradox, which we've discussed in previous programs. The dollar serves two markets, the global market and the domestic market, and those are not always in sync. Sometimes they're in conflict, and no empire has ever become stronger by weakening its currency. And so, although nobody talks about it, the United States has to protect its reserve currency, which is part of the petrodollar and the commercial empire of the U.S. Its dominance globally is not just military, it's based on the reserve currency. So people saying, oh, well, the Fed's going to drop to negative rates so that to boost the domestic economy. It's like, well, you better rethink that, because the Fed has to defend the reserve currency. They just can't talk about it. And so everybody's talking about the dollar weakening. Well, what they're saying is Europe and Japan are going to do better. And it's all like, wait a minute, let's take a look at that. Credit impulse has been dead in those two economies, in the case of Japan, for decades. And they're also extremely export dependent. You know, Japan is an export dependent economy. So is Germany, which is the engine of the EU. So that's also questionable. So, and the other thing people forget about is the U.S. is a import dependent country, right? And so that means we need foreign capital to flow into our economy. Well, if you're going to go negative and have your rates lower than everybody else, then capital's going to flee. So that's a non-starter. So all these assumptions that are made about the dollar don't make any sense once you consider the dollar's role globally. That's my point.
Charles, the dollar itself, and you correctly point out, through the euro dollar, is the basis of about 95, 98% of every transaction going on in the world right now. There's $5 trillion of currencies that exchange hand every single day, and they're dominant with the US dollar. That doesn't say that the dollar isn't flawed, but the system is so dependent upon it that any major shifts in it have catastrophic consequences, not to just the United States, but every single country in the world. And additionally, as big as the dollar is, U.S. treasuries are the basis of what they call risk-free benchmark. So risk-free is considered, for example, the 10-year U.S. Treasury. We could argue there's risk in it, but nevertheless, all basis of risk is measured off of the United States Treasury. So those two, the measurement of risk for any kind of investment and debt structure, and the U.S. dollar for any denomination of what an asset is worth, are all dependent on the U.S. and frankly U.S. policies. So any disruptions in it are just incredible. It is not about, as you correctly point out, it is not about the United States economy. Frankly, you could say that the central bank, Federal Reserve, is a central bank to the world. It obviously is not, but its decisions are profound. Charles, I have up a dollar chart, that one of many we have over at MATA SII, on what we think is going to happen. I actually did a video here not long ago on U.S. dollar devaluation. And the chart here, it's a little small maybe to see, but we've just recently, if you can see this rising colored channel, we've just put in a reverse head and shoulders, and I've labeled it LS for the left side, then the head and the right shoulder, and it's inverse. And usually what happens is you can see the head to the neckline. When that neckline is broken in red, the distance it will travel up is equal, and we're reflecting that here. So recently, we've been expecting and have seen a dollar weakness, and we call that out. We didn't know how far it would go on this initial drop, because if you explode this chart, you can see some very long-term moving averages are crossing. But we seem to have, we didn't quite go down to the channel. It could have got a lot worse. Because we are in a recession. We're in a period going through the U.S. elections, but it has recently really started to put in a pretty hard bottom here and started to rally up. It may move around, but what we do see is labeled here in green, maybe a little bit more consolidation going to the right before we start to rise up. And we can see the dollar strength being quite strong as a flight to safety. Really, that's what it is. Out over the next period of time. And what the hesitation there is, it's about for example, the euro. There are massive problems. The United States has problems, but some of the other countries in the world have much bigger problems. And one such entity is the European banking industry. And any kind of problems, and they finance, the European banks are in a lot of loans around the world that could easily start defaulting or problems. And a lot of that's going to happen because of a recession, the COVID follow-on, the supply chain disruptions, and we're going to move into stagflation. And as these things are shifting, there will be more importance of the dollar and more shifts in terms of credit and the Treasury. We'll get to that in a second. So we actually see right now we're focused on what will happen with the euro, but any continued weakness in that euro, it's been strong here recently, will explode the dollar higher. So, in our video, just to conclude, our video that we put out, we said we're going to see a weakness. We've seen it, but we also argue in there that at some point this dollar, the overall dollar, will need to come down. And it will come down, but remember, as it comes down, every fiat currency will come down. And we've always believed that the U.S. dollar will be the last to actually start a precipitous fall. That doesn't mean that gold and precious metals aren't going up. Typically, when the dollar goes down, gold goes up, and when dollar goes up, gold goes down or precious metals. We're arguing on the right-hand side that we actually see when the dollar goes up next time and starts to break, especially that neckline, gold and precious metals will go with it because it's heading to that too, which is really getting down to a question of whether fiat currencies are sustainable with the debt structure. It doesn't mean the world's coming to an end. It means maybe a new Bretton Woods global agreement, a new shift. It'll be a crisis, but the world will come through it. And do I make sense there, Charles, on that subject?
Yeah, and I'm glad you described how precious metals and the dollar can both go up, because we have to remember fiat currencies are doomed, right? I mean, they will implode, and so there's solid reasons for holding precious metals. But remember, businesses, commercial interests, they have a lot of dollar-denominated loans, 3 trillion plus globally. And so businesses need dollars. They can't just survive by putting all their capital in gold at this point. So they're gonna be acquiring gold and silver and other hard assets, but they still need dollars. And so that's why, as you say, Gordon, it'll be the last currency standing. And so when it falls, then the global economy will enter a terminal crisis, because you're talking about not just currencies, but you're talking about the energy markets, the treasury markets, the debt markets, the credit, everything. So,
but it's still out. It's not imminent.
Right.
And it's still, so we can talk about it, but you can't trade it. You just got to understand what the potential is, because as this dollar goes up, the way we're suggesting that happens, that on the surface sounds good, but it's actually terrible news, because the emerging markets and everything around the world have all their debt denominated in US dollars. So they're having weaker currencies trying to pay their debt off in these big dollars. It's just crushing to their economies. This chart is almost a death knell for emerging markets and some of the developed countries around the world. This is a very troubling chart. Not the down when we say at the top right, where we're at number 2, where we start. These, for those that know Elliott Wave, 1, 2 says you have a 3 down, and it'll go deeper than the 1 over here on the left. That strength will actually lead to the fracturing of the fiat currencies. And we have charts that we've shown the stages of how that would unfold. Charles, let's switch to credit expansion, because it does tie in. On the credit, the Fed quantitative easing will spark a new round of credit expansions. And we won't call it quantitative easing, but more fiscal spending, and fiscal and monetary, as some people are assuming with the Fed, but it's also into things like MMT and fiscal spending. And you've got a number of arguments on what you think, how false that is.
Right. I think the problem with the idea that liquidity will generate good credit risks, that's a disconnect. I mean, just providing the system with liquidity doesn't mean that banks can afford to lend to poor credit risks. They can't, because they cannot absorb the losses from defaults. So the Fed can create liquidity, but it cannot create low-risk investment opportunities, and it can't turn poor credit risks into good credit risks. And banks can't afford to lend to insolvent households, zombie corporations, or small businesses. And so there's nothing the Fed can do. So assuming that liquidity is going to equal credit expansion is, to me, a delusional assumption.
Central banks can create liquidity, but they can't make banks lend if they're not going to make bucks, and they can't make borrowers borrow if they don't have collateral or the need for the money or the wherewithal to get the money. That's the problem with this chain. And also, liquidity doesn't fix solvency problems. And we have solvency problems also right now. So even if it does push out the credit, it's going to be insufficient, not necessarily in the short term. I think some more liquidity pumping will continue to push positive asset values, but it's quickly running out of steam. The thing we need to watch for, Charles, and I have a chart up here, is the credit impulse from China. And while all the financial people are preoccupied with the Fed, and it should be, and its $7 trillion balance sheet, and whether Powell is purchasing bond ETFs or has stopped doing so, as he did in August, by the way, and whether the U.S. central bank has any hope of sparking inflation with or without the help of Nancy Pelosi and Congress, what's most are forgetting, in my mind, is that when it comes to any global reflationary spark, China and its $40 trillion financial system, which is double that of the U.S., has been a far more critical driver than the U.S. Has been since the financial crisis in 2008. That's continuously being lost. And so you have to realize 5 months, about 5 months after China injected, let me think now, it was a record 5.2 trillion yuan, that's like three-quarters of a trillion, $1 trillion, 732 billion, I believe, in new total social financing. That's what they call it. Which is China's broadest credit aggregate in March, to offset the catastrophic hit in its economy that they were suffering from the COVID pandemic. Beijing once again surprised to the upside the world in August, where they injected a whopping 3.6 trillion yuan in its economy. That's $500 billion above the highest Wall Street estimate, which was 1 trillion yuan above the consensus estimate, and the biggest monthly injection since the March record. Now, what does that mean? And this chart tells you what it means, and this is what we've seen, is that the credit impulse actually leads what'll happen to the United States Treasury, the 10-year yield, the 10-year real yield. And that's important that you understand it's a real yield. And you can see that they track very, very closely with as I said, with a 12-month lag. So what's happened is we're running so right here in March, we're coming up to a year. And as we go into August, it explodes. And so what happens when that happens, the net of it is that the United States treasuries will go up in price. Credit will therefore get more expensive. I didn't talking about being available. It's going to get more expensive. And it could be a rather significant spike. And we've got all sorts of 10-year bonds and technical analysis showing where it is and where we think where it'll take us to. But certainly 1.25 to 1.5 on the 10 years looks like almost a foregone conclusion sometime between now and the spring. That is one serious hit to the global credit market. And unless this chart just says for some strange reason, since the financial crisis, this is not going to work, I don't know. But it's certainly made us some money, that's for sure. And I'll leave it at that. Any comments on that chart, Charles?
No, I'm glad you brought that up though, as a roadmap for people to understand that that we're talking about global issues. We tend to focus on our domestic economy, but the domestic economy is part of a global system, and so there'll be global consequences.
As an American citizen, I'm very proud, but we're getting to be the tail on the dog, Charles. And it's not that our economy isn't the best economy going here up until the COVID. It's just that there's so many other, China, Japan, so many other large economies that are cranking out more money than we're cranking out, and have deeper financial problems than even ours. So don't trade that chart, but certainly give it a lot of thought, because this is not what people are talking about right now. Not even mentioning it. The other thing next one is fiscal stimulus, the impact of the fiscal stimulus itself, that the federal government will borrow and spend trillions, sparking a renewed growth. And so what could go wrong there?
Right. And so the general assumption is that we're going to get renewed growth because the federal government's going to just borrow and spend, or the Fed's going to buy, treasury bonds, and trillions of dollars will flow into various things, infrastructure and support for the unemployed and so on. I think what could go wrong is the money will not flow into productive investments. it'll flow into demand for goods and services, which are constrained by declines in trade and retirement of key workers and other bottlenecks into production. And so this will drive the inflation that you've been describing in great detail recently. And I also want to make a point about wage inflation. We haven't had wage inflation for literally 40 years for the bottom, say, 60%, and very little for even the top wage earners. But as universal basic income and other types of helicopter money are institutionalized, the working poor who are struggling to make it on their low wage jobs will figure out they're going to live better by just stopping work and living off of UBI and helicopter money. And small businesses will not be able to increase the wages. And so this is like another bottleneck for productive investment. And you're not going to be able to solve that with more helicopter money. In fact, you're just creating more incentives to exit the workforce.
Charles, we just put out a newsletter this morning, actually. We put out a couple a week. And by the way, for those who haven't signed up, they're free to sign up at Meta SII. But one of the charts in today's newsletter was exactly what you just said. The wages are actually truly starting to spike up. And you say, whoa, what are you talking? No, but wages are where they're spiking are for those who are skilled and highly trained or have jobs that are tough to find somebody to replace them. Typically, highly educated professionals. They're keeping their jobs, and people are paying more money to make sure they keep them. So those are where it's spiking. That is not what's happening with the working middle class and lower. Their wages are not spiking up. What's spiking up is the inflation at the food store and everything that you need and that you use, not what you want, but what you need. And we've laid that out in other videos. But that's exactly what's happening now. Are you seeing the same thing?
Yeah, and I think that we could see wage inflation even in the lower paid jobs because businesses still need those people. And if people won't take a job at $10 an hour, then they'll have to raise the wage to say 15, or it could even go that you need to pay $20 an hour, depending on how generous universal basic income and other helicopter money is.
It's almost a pre-gone conclusion that we're going to see some form of universal basic income in the future, isn't it, in the United States, as socialist as that is. That's quite a statement for me to say, but you sense that too, I gather.
Oh yeah, absolutely. It's in the works, and so
helicopter money and MMTs almost a foregone conclusion, but the shift to socialism. This is not a party statement here, a political statement. We are clearly moving towards socialism, almost out of need, and I don't think that's a solution when I say out of need, but to keep what are potential civil unrest and riots under control for people. You know, when people can't eat or support their families or get by, things get very tough in every country, and in many places that's where the level that we've reached, and the government is going to have to open up the vaults on that, which is called printing money. So the next one we had was, you know, this old adage, Charles, don't fight the Fed, right? The Fed has our back, so stocks, bonds, etc. Will continue to move higher because the Fed, well, print is easing, and if there's a problem, they'll just put more money into it. What's wrong with that one? What could go wrong there?
I think the potential of a deflationary crash is being underestimated because people aren't realizing that how indebted households and zombie corporations are, and they may be forced to liquidate some of their assets just to raise the money to service their debt. And the other thing that people might not be realizing is expanding the debt doesn't expand profits, payrolls, employment, or capital spending. You know, in other words, you're really pushing on a string. And people also probably underestimate the amount of leverage that's been piled into the system to create the returns that are necessary for pension funds and fund managers. So that's why I think "don't fight the Fed" is a delusional assumption.
It's worked very well. It's been almost a guarantee for 35 years, and that's why why everybody believes so strongly in it. But you can only push on a string so long and so far, and when it breaks, you're on the wrong side of a major swing. The next one is that there's a sense that there's a pent-up demand, that there's built-up demand everywhere as we come out of COVID, so growth will soar. I certainly hear politicians talking that way. So what could go wrong there?
Yeah, real quick, businesses are under such pressure to keep their profit margins up as revenues decline and the costs go up. I don't think we're going to be seeing the 28 million people that are collecting some form of unemployment insurance. They're not all going to be hired back. Businesses have got to cut costs, and their fixed costs are rising, and so the only thing they can do is trim labor, right? And so I think the next wave of layoffs, and we're already starting to see that with Disney and the airlines, the next level up from the lowest level employees, managers, and other high cost labor, the next wave will start decimating those ranks of middle class and upper middle class workers. And so the whole idea that you can there's going to be a huge surge in earned income, I think, is delusional. The other thing I also am seeing is, and sports is one example, as people have pulled away and been unable to go out and do things they used to do, a certain percentage of people are realizing they don't really miss any of that stuff. And another group of people realize they can't afford it. They can no longer afford to go to sporting events or music venues or eating out because their income has fallen and it's now insecure. And so I think there's reasons for demand to stagnate, not soar.
Another issue is we've had since 2012 quantitative easing, one program QE1 through 4 and etc. And remember what that was about. Quantitative easing was about bringing demand forward. So by continuing to lower interest rates, and we took them all the way down to zero thereabouts, and still have kept them at zero. During that period of time, 2012, 2014, through pre-COVID, that's what we've done. We brought demand forward. Well, let's understand what that means. That means there's a big hole of lack of demand because people have bought forward. So you can't take interest rates any lower to create more demand, and then you've got all these issues you're outlining with unemployment, which is going to create further falling demand. So I would argue it's not pent-up demand. We have a pent-up lack of demand that's going to hit us right square in the head. Ever mind the disruptions to the overall global supply chain. So I think that's a ridiculous argument for whoever wants to not to believe that. You can believe it, but you're not going to do it with my money, Charles. The next one we have is continued and stable growth, that everything has returned to stability, and the future growth is now predictable and to be expected. I think we kind of touched on that, but you had a point that you wanted to make on that.
Just real quick is that the extremes of policy that are required to keep the status quo afloat, just because the amplitude keeps increasing, like where $1 trillion was enough, the Fed could print. Now they printed $3 trillion, and people are talking about $6 trillion. And so these swings of extremes in sentiment, capital flows, debt, the amplitude is increasing, and the time span between these wild swings is diminishing, so that we're getting more and more instability. So the idea that you can predict what the U.S. economy is going to be doing next year, I think that idea is delusional.
Well, also, Charles, we've got some major structural changes in approach going on. We effectively have the beginnings of deglobalization. More and more countries, ourselves including, are more talking about nationalism, bringing jobs home. We're seeing tariffs Some of them have worked to some degree, but they've never been good for trade in global trade in the long term. We're seeing more of that. Ever mind the kinds of sanctions that are becoming basic policy of America to exert its foreign policy. I would call it weaponizing the U.S. dollar, but that's a whole discussion we've written about here quite extensively. But also, additionally to all that, we've got a lot of global conflicts that are going on right now, and some of them are really serious that aren't getting a lot of attention. But any global conflicts hurt trade. It's peace that fosters trade, and so that's not going to, hurting trade's not going to help growth. And we've got conflicts right now, major ones between India and China, Iran and the entire Middle East. Armenia and Azerbaijan are now firing missiles at it. We got Turkey, Greece, and Cyprus in the Mediterranean. We got a Cold War now between China and the U.S., and that's the only word I can use to describe it. We have the beginnings of a new Cold War. And I could go on, but I'm not predicting war, but they're conflict. And when conflict starts, trade slows, trade stops in some cases. It goes other places. It doesn't help create, as we said, stable growth. It's not going to create stable growth. It's going to create minimally very disruptive growth. So I think that's just another false assumption. The last one we had was low global energy prices, that global energy prices will stay low for all sorts of reasons of slowing economy maybe, and therefore it would foster growth. Is that
right?
What could go wrong there?
Well, as you said, Gordon, the Middle East is still the primary source of oil, and there's a lot of conflicts there. But what many people may not understand is that oil-producing countries, by and large, require a very high price for oil to fund their own social welfare programs. In other words, they've promised their population growth and benefits that require a price of oil, in many cases, about $85 a barrel. And so it's about 40 now. So they're basically either eating their seed corn, selling off their investment to raise cash, or they're borrowing money against future oil revenues. And so this is unsustainable. So, and if prices drop back into the 20s or 30s, a lot of production is going to be capped because no one can afford to pump oil at that and lose money. And then once you get a huge drop in supply, even if the global economy slows, you can have a spike. And we've seen this over the decades, right? And one of the most reliable indicators of recession is a spike in oil prices, because this immediately means people have to spend their scarce, earned income on energy instead of on other consumables. So I think we're going to see wild swings in energy prices, and either too much or too little is both extremely creates more instability.
Charles, we've been on a little longer than we planned, so we need to wrap here with some conclusions. I think what we're seeing is really we're going to expect in reality slowing rate of global growth, loss of investor confidence. And we've been talking about a long time. The debt is finally going to become quite problematic. We did a video here in the spring where you and I were talking about a coming reversing wealth effect, and that's what all this leads to. The wealth effect has been powering us higher since Bernanke went after it, because he knew he couldn't increase credit at the rate it needed to be created. He had to drive it in the wealth effect, and he specifically targeted the asset markets, even though he knew what it would lead to in the form of bubbles. But we're going to see that reversing wealth effect looming in front of it, and there's investor consequences of that. Protracted period of subpar earnings, shift from growth to value, likely more pressures on hard assets like precious metals, and we've already beginning to see that. This chart we talked about, I think, in that session. I don't see a V-shaped recovery. You maybe a Y out a little further in terms of the U.S. economy, but globally, I think it's going to be protracted. And this was the charts, the sequence that we saw going through the stages, and we're seeing them unfold right now when we did that video on the breaking of the wealth effect. reversing the wealth effect of unemployment, and this is forced cuts that are going to happen, bankruptcies, the amount of zombie corporations, and triple C rated corporations that are going to fall into junk bond and therefore can't be held in insurance and pension plan portfolios, and what's going to happen there, reduce consumption for the reasons we outlined here today. We've talked about real estate then becoming problematic. If nothing else, everybody's learned right now what Zoom economy looks like, and the need for real estate is, you're already seeing it change ever mind in retail side of the house, whether consumption or just new distribution. I'm talking about places like Amazon. And here's the reverse wealth effect that finally, as those things are really unfolding, will kick in. And then the whole issue with lenders. Their levels of leverage that they have, never mind what's going to be their ability to get the money. And so we're going to see banks and financial institutions and another credit crisis. Don't be worried with the word crisis. It just means more dislocations and more changes that'll happen. And so we're kind of like this Wile E. Coyote right now, kind of still holding up there in the air. But the realization, if you look at the assumptions, that people will start to look at these assumptions and say, I think I got something wrong, but it's too late. Any closing comments you want to make here, Charles?
No, I think you've chosen the perfect slide there with Wile E. Coyote, and we're raising issues that don't make assumptions that what worked over the last 12 years are going to work in the intermediate future.
We know they won't work. But I'm going to repeat what I said before. Don't forget that the government, that Fed, powers to be, will change the rules. That's what you have to watch for now, because they're getting more and more desperate. But the good news is they're kind of trapped in the number of options that are available. So you can start to anticipate what they're going to be forced to do. We've already made an assumption here that you and I both feel that universal basic income is a given. Well, where's that money coming from? That goes to another conclusion, right? So a lot of these decisions they're pretty well trapped in what rules they'll have to change. Let's break, Charles, and I guess we'll talk again in another 6 weeks or so.
Yeah, looking forward to it, Gordon. Thank you very much.
Talk to you then. Thanks, Charles. Bye-bye.